we are being joined by the expert of who is MD and CEO of Edelweiss AMC, none other than Radhika Gupta, where we will seek her guidance on how should one look forward to investing in fixed income securities and what could be the implications in that investment because of the rising interest rates. Radhika, it's a pleasure speaking with you. We want to talk about investments and interest rates and have more perspective from you. But before we go ahead, would like to know from you, in your experience, speaking to the number of people that you do, and especially from the product side, do you feel there is less awareness about fixed income mutual fund schemes? And why do you think so it is?
I think, unfortunately, for some reason, people, when they assume the word mutual fund, they assume it to mean equity, not realizing that mutual fund could include fixed income, it could include equity, and it could include products in the middle. It is a little unfortunate because not only are people not aware of debt mutual funds, it's important that they become aware, because debt mutual funds, in comparison to traditional fixed income instruments like fixed deposits, carry a very important advantage, and that is of taxation. I think people often forget that when you invest in an FD, you pay the marginal rate of tax, which is 30% for a lot of people. But when you invest in a debt mutual fund, you get the benefit of 20% tax over indexation. It effectively works out to about 10% taxation. That 20% is a big delta. I think awareness of fixed income funds, how to choose fixed income funds, and the benefit of investing in fixed income funds, especially the one that relates to taxation, is something that we have to keep working on as an industry.
Yes, absolutely. And hopefully people get more awareness on this front. But in your experience, I'm sure that you have been asked this question many times before, and I'm sure a lot of viewers are wondering now, what role do fixed income mutual fund schemes play in a portfolio? And within that structure, where does Bharat Bond ETF fit in as a long-term investment option?
Sure. So I'll take this in two parts. I think in this market, you get a lot of questions. My equity is up 3-4% in a month. Fixed income is going to do that in a year. Why should I even invest in fixed income? And I always say good investing is a little bit like a balanced diet. As good as proteins are for you, you need fat and you need carbs. And I think a good portfolio is about having diversification of asset classes, about having that asset class. So while equity is a wealth creation asset class, there are times when you need fixed income because that is a safety asset class. Markets do have great phases, but they do have drawdowns, and debt acts as that cushion in your portfolio. It also serves your short-term liquidity needs. Now, where does Bharat Bond come into this, which was your second question? Bharat Bond, I think, is a very unique structure for fixed income investors, long and medium-term investors. Bharat Bond has got a structure that is very similar to FDs. It's called a target maturity structure, where there are different products of different maturities. So there's a 2023, a 2025, a 2030, we just closed the 2032. Based on your investment goals, if you want to invest for 2 years or 3 years or 10 years, you choose the Bharat Bond tranche that works for you. And all we do is we buy and hold the highest grade AAA-rated public sector bonds of companies owned and managed by Government of India. So the highest credit quality. And your experience really mirrors an FD. So you have an indicative sense of how long you will invest for and what kind of return you will earn. So Bharat Bond works. You can get a Bharat Bond for your time horizon, is what I'm saying, all the way from 2023 to 2032.
Yes, absolutely. But Radhika, with interest rates which are expected to go up, the advice being dispensed is that stay on the shorter end of the yield curve. Do you think that will make individuals wary of locking their money in long periods, like you highlighted that for Bharat bonds, there is an option for investors to lock in for a longer term period? What's your opinion in that?
See, I think the comment on interest rates going up is absolutely a valid one, but I think that applies to corporate investors who invest for shorter periods, 3 months, 6 months, 1 year. For a lot of us, we invest in fixed income as a part of our asset allocation, and we have investments. I want to get my daughter married in 5 years. I want to provide for a school. I want to study abroad in 5 years. We have long-term investment needs. The great thing about structures like Bharat Bond or these target maturity structures is they are hold to maturity structures. So if you buy these structures and hold them to maturity till the date and align it with your goals, actually you are agnostic of interest rates. And I think investors need to realize that we spend a lot of time on timing, equity market timing, debt market timing, but there are now products created to serve goals regardless of interest rate movements. And I think the response to the issue of Bharat Bond 2032, where we had to extend the green shoe option and actually take more investor money in a 10-year product at this time, shows that there is a group of investors who wants to just simply meet their goals in a bond product.
Okay, absolutely. But Radhika, my last question to you is, there have been suggestions made to use debt laddering as a strategy. How would that work?
So debt laddering is a super effective personal finance strategy, and it works really well with target maturity funds fund. If you have 100 rupees, break up the 100 rupees into goals, money that you need in 2 years, 3 years, 4 years, 5 years, etc., etc. Once you have those goals and time horizons, take these target maturity funds like Bharat Bond or other target maturity funds that there are out there, and there are lots of them out there, and match the time horizon and maturity of the maturity fund to your goal. What you will have then is a portfolio of products that is maturing every couple of years, just in line with your goals. So 3 years later, when you have that goal come up, you're not worried about what's happened to interest rates because you've matched it to your goal. And you also have periodic cash flow. When things mature, again, you can reinvest. Laddering, as I said, is a very, very popular strategy globally. Till a few years ago in India, you could not think of laddering because you didn't have target maturity solutions. Now at Edelweiss AMC itself, we have 7 products in a 10-year curve. So you can build a full ladder of debt products.